In the last class, we have discussed how to claim the loss of profit insurance. I mean, how to calculate the claim under loss of profit insurance, Today, we are going to discuss how to claim additional expenses. How to claim additional expenses. What do you mean by claim for additional expenses? We have already discussed that during the dislocation period, during the affected period, the normal sales cannot be achieved. So the normal profit cannot be earned. So in order to avoid that reduction in turnover and reduction in profit, some additional expense may be incurred by the company. That is called additional expense or increased cost of working. Say for example, we may shift to, during this dislocation period, we may shift to a rented building. Actually, we will have to pay additional rent. That is for the purpose of improving the sales, in order to avoid reduction in turnover. So that rent paid is an additional expense. In that way, some additional expenses may be spent. So we may give a claim for this additional expense also if the policy so provides. In that case, how will you claim for that additional expense or increased cost of working? That is the point of discussion today. So for calculating the additional, claim for additional expense, what is the information given in the problem? Let us discuss with an example. So for example, date of fire is given on 1st August 2018 and turnover from 1st September 2017 to 1st August 2018 is 5 lakh. What is this turnover called? This turnover is called annual turnover. It's a new term. What do you mean by annual turnover? It is the turnover for the 12 months just before the date of fire. Here the date of fire is 1st August 2018. So annual turnover is the turnover for the 12 months period just preceding, just before this 1st August 2018. That is 1st September 2017 to 1st August 2018. That particular turnover is called annual turnover. That annual turnover is relevant here. It is 5 lakh. That will be given in the problem. Then suppose the GP ratio is 20%. And affected period is, say for example, 1st August 2018 to 31st December 2018. And the affected period turnover, that is the turnover for the period 1st August 2018 to 31st December 2018 is suppose 1,50,000. And remember one point, out of this 1,50,000, 50,000 has been achieved because of additional expense spent. The additional expense is suppose 20,000. So if you had not spent that additional expense of 20,000, sale of rupees 50,000 would not have been achieved. So the total affected period turnover is 1,50,000, out of which 50,000 is earned by spending this additional expense of 20,000. So this 50,000 turnover is called saved turnover. So what do you mean by saved turnover? Saved turnover is the turnover achieved because of this additional expenses. Remember, if such a specific turnover is not given, assume that the affected period turnover itself is the saved turnover. Okay, then what is next information given? Savings in standing charges. Some fixed charges we can avoid during the dislocation period. Say for example, the wages for some casual workers may be avoided. Their service may be terminated because of the lag in the dislocation period. We may avoid the service of that casual workers so that wages may be avoided. So in that case, there may be a savings in standing charges. Say for example, it is 5,000 in this case. Then uninsured standing charges may also be given in the problem. That is standing charges not mentioned in the insurance policy may be given in the problem, say for example 25,000. If all these information is given, how will you calculate the claim for additional expenses? Say, least of the following three will be claimed. What is least of the following? See, actual additional expenses 20,000. Actual additional expense, for example, 20,000. We have already discussed. Then GP on saved turnover. GP on saved turnover. What do you mean by GP on saved turnover? GP on saved turnover. The saved turnover, that is the turnover saved because of the additional expense, is 50,000, and 20% of that 50,000 is 10,000. That is the GP on saved turnover. Saved turnover into GP ratio, 10,000. And if there are uninsured standing charges, that is, if all the standing charges are not insured, GP on annual turnover divided by GP on annual turnover plus uninsured standing charges into additional expense. What is the annual turnover? Annual turnover given is 5 lakh, and GP on annual turnover is 20% of 5 lakh, that is 1 lakh. So GP on annual turnover divided by GP on annual turnover 1 lakh plus uninsured standing charges, it is given 25,000 into additional expense, that is 20,000. Then you get 16,000. So out of these three, the second one, that is GP on saved turnover 10,000, is the least. That will be claimed as additional expense, you know. So additional expense is that can be claimed as 10,000, from which the savings in standing charges is 5,000. If such savings in standing charges is there, that must be deducted, then you will get 5,000. This is the ultimate claim for additional expense. So for claiming additional expense, least of the three will be taken. Actual additional expense 20,000, then GP on saved turnover. Saved turnover is the turnover achieved through additional expense, that is 50,000 in this case. 20% of 50,000, 10,000. Then GP on annual turnover divided by GP on annual turnover plus uninsured standing charges into additional expense, you get 16,000. Out of the three, 10,000 is the least that can be claimed. From that amount, savings in standing charges, savings in fixed charges, if there is any, must be deducted, then you get the claim for additional expense. I hope you got the point. Yes, we will meet in the next class with a new topic.